somebody who wanted to join the session without getting the proper invite. Okay, let's go back to what I was talking about. So we're talking about deemed disposals. So we're saying if you commence being a resident, it's merely to establish what is your base cost. Sorry, did I unmute? Yeah. So it's merely to establish the base cost of the asset, and not that you'll be subject to capital gains tax when you become a resident. It's just to establish a base cost, so that when you then dispose of those assets, subsequent to you becoming a resident, then we can then calculate what is the capital gains tax on the disposal of those assets. Okay, or in an instance where you cease holding assets as a personal use asset, so you cease holding assets as personal use assets, then you will be subject to capital gains tax, because remember, when you hold an asset as a personal use asset, you qualify for the exclusion under paragraph 53 of the 8th schedule. But now, if you no longer qualifying for the exclusion under paragraph 53 of the 8th schedule, then what we then do, you are deemed to have disposed of that asset, okay, and immediately acquire that asset, okay. And therefore, we then establish what is the base cost of it at that point in time, and then you'll then be subject to capital gains tax on it going forward, right? And similarly, when it comes to trading stock, where you are changing from holding something as trading stock to holding it as a capital investment, there will be a recoupment, of course, in terms of section 22, subsection 8, and then we then establish the base cost of that asset for the purposes of capital gains tax going forward, seeing that you're no longer going to be holding it as inventory, but you're now going to be holding it as a capital asset. Okay, so the important thing under paragraph 12 is that the disposal is at market value. However, in an instance where there's a sale of an asset between spouses, and those spouses are married in common of property, then those spouses are one and the same person, which means then they jointly and severally own whatever assets that they own, because they're married in common of property. So in an instance where assets from a joint estate are disposed of, then it is deemed that each of the spouses has disposed of their share of those assets. So you've got assets that form part of a joint estate, then it is deemed that each of the spouses has disposed of their share of that asset in that joint estate. So that's why, even if, for example, your spouse disposes of an asset and you are not aware that they've disposed of an asset from your joint estate, you will still be liable for capital gains tax on your portion, right? If, let's say, your spouse is then a person that is not trustworthy, and they dispose of an asset and they do not tell you that they've disposed of an asset, then in that instance, you are still liable for capital gains tax on your portion of the asset that has been disposed of. Okay, right. And then the other one, we spoke about ceasing being a resident, which is then dealt with under section 9 cap H, where it says that if you cease being a resident, then you are deemed to have disposed of all your assets. And then we've got the exceptions, which is the 3 that we spoke about. That we then say, okay, you've disposed of your assets, but those 3 are exceptions, which means those ones you are not deemed to have disposed of those assets, because they'll still be subject to capital gains tax within the Republic. Okay, so I won't look at this example in the interest of time. So we spoke about disposals, we spoke about asset. Let's then talk proceeds and base cost, and then we're then going to jump into today's tutorial. So what is proceeds? Very quickly, proceeds, you're then looking at, in an instance where you've disposed of an asset, it is the amount received by or accrued to a person in a particular year of assessment. So if you look at that, that is very similar to the gross income definition, because gross income definition says amount received by or accrued to in cash or otherwise. Okay, here again it talks to an amount, right? So now when you're trying to then determine what constitutes an amount, you'll have to use the case law that is applicable under gross income. Okay, so things like Lategan, those are the cases that you then look at and say, okay, what is the amount? And then again, received by or accrued to, it will be the same case law principles that you then use to determine whether an amount has been received or it has accrued. Okay, so definition of proceeds, very easy. An amount received by or accrued to. And what does it include? It includes any amount by which debt owed by a person has been reduced. Okay, so if you owe an amount and that amount has been reduced, that amount will then constitute, the amount of that reduction will then form part of the proceeds of that asset. Or in an instance where there's cash paid by the lessor to the lessee in lieu of leasehold improvements, that then constitutes an amount received as part of the proceeds. Okay, so very, very simple definition in terms of what constitutes proceeds and what must be included or excluded. Over and above that, there are then certain things that must be excluded from, or must reduce the proceeds on disposal. And what would those amounts be? So if there's any amount that has been included as part of gross income, so an amount is included as part of gross income, therefore that amount must be excluded from the proceeds, because then if it's not excluded from proceeds, then you're going to end up with a double taxation on the same amount, because it would have been subject to tax when it's included as gross income. It will also then be subject to tax when it forms part of the proceeds under the 8th schedule. Okay, so that's why you then take that amount out of your proceeds. Your proceeds if it was previously included as part of the gross income. Okay, or if you've got any amount of proceeds that is repaid or becomes repayable to the buyer. Okay, so the amount is repaid, then that amount must be used to reduce the base cost of, not the base cost, but the proceeds on disposal of the asset. Okay.
Sir?
Yes, ma'am.
I want to just quickly, please correct me on this point. When you say amount, right? Especially when I see a CGT trigger on a case study, obviously using my undergrad knowledge, I'll think of a value like, let's take 40,000 rands and so on. But the thing is that now you are talking about amount in gross income that it can be in cash or other form. So can that be also be applicable on this one, on proceeds?
Yes. So that's why I then said, if you look at the definition of proceeds, it's exactly the same as what you will get under the gross income definition, in that it talks to an amount. So then in you determining an amount, you have to look at the case law that is relevant when you're looking at gross income definition.
Okay. No, I understand now. I get it.
Okay. All right. Okay, thanks.
Thank you.
Okay, so when you're then looking at the base cost of an asset, now remember, a base cost is what you can claim as a deduction. So when you're looking at the base cost of an asset, we are then saying, okay, what is the expenditure that you've actually incurred to acquire that asset? So I think the key thing is around, it's an expense to acquire. Okay, that's a big driving principle around a base cost. It's an expenditure to acquire. Okay, and then you then of course have things that are specifically then included in the definition of what is a base cost. All right, so things like when you are selling an asset and you have to pay transfer costs, or when you're acquiring an asset or you're paying transfer costs, stamp duty, transfer duty, or any similar duty, that's then included as part of the base cost. If you look at things like advertising costs to find a seller, so with advertising costs to find a seller, you don't reduce your proceeds, but simply you add that amount as part of your base cost. In an instance where donations tax has been paid on a disposal of an asset, then you are entitled to include a portion of the donations tax as part of the base cost of that asset. And how you calculate that portion that must be included, it will then be the cost of the goods divided by the market value of the goods and then multiply that by the donations tax value. Okay, so effectively with that formula, you're then saying what is the percentage of my cost compared to the market value of that asset. Okay, so what is the percentage market value of the cost? Sorry, what is the percentage of my cost to the market value? And then you multiply that by the donations tax that was paid. Okay, so those would be things that are specifically included as part of the base cost. Of course, there are things that are also then. Sorry, I'm gonna, in the interest of time, I'm gonna skip through these. In an instance where you dispose of a part of an asset, all right, you then need to apportion that part. So where you can't do a split of an asset, however, but you are disposing of a portion of that asset. What you need to do, you then need to say, okay, fine, what is the total cost of the entire asset? And then say, how do I then allocate a portion to that part that I'm selling? Okay, and how you would do that, of course, you would then say, okay, what is the market value of the portion that is being disposed of as a percentage of the market value of the total asset? I usually like using a truck as an example. Let's say you've got a truck, a horse and trailer. Okay, so a horse and trailer is one truck, and you bought them as one truck, as a horse and trailer. There was no allocation of cost to the horse as well as a cost to the trailer. You simply said, can I please have a truck with this trailer? And they said to you, okay, fine, a truck and this trailer is going to cost you 2.5 million. You said, thank you very much. Here's your 2.5 million, and you walk away and you started using that truck. Then at some point, you then decided, you know what? The trailer is not suitable for my needs, and therefore I need to dispose of the trailer. But now, because you paid 2.5 for the entire truck with the trailer, we can't then attribute a cost to the horse as well as the trailer. But now how we can then do a split of that, what we do is we then say, okay, fine, what is the market value of the trailer at that point where we're disposing of it? So what is the market value of that trailer at the point where we're disposing of it? And we take that market value of that trailer, we then divide it by the total market value of the truck. So meaning what would be a total market value of a similar truck with, and when you're saying a similar truck, meaning the horse and the trailer, what would be a market value of that truck if we were to sell the entire thing in total? So we then get that percentage, and then we take that percentage and multiply that percentage by the base cost of the asset. That will then be the portion of the base cost that we are then saying is being disposed of. Okay. In terms of capital losses, so in an instance where you've made a capital loss, you are entitled to apply it against any capital gains that you've made. However, there is an exception in terms of paragraph 39. And paragraph 39 then says, if you've made a capital loss from a transaction with a connected person. Okay, so you've made a capital loss from a transaction with a connected person, then that capital loss must be ring-fenced. Okay, so that capital loss must be ring-fenced. What do I mean by ring-fenced? It cannot be applied against other capital gains, except if it's a capital gain from that same connected person. So it cannot be applied against other capital gains, except if it's a capital gain from that same connected person. Okay, so we won't use it, and we'll only use it from a capital gain that is generated from from a transaction with that same connected person. Hello? I can hardly hear you. You can go ahead. Yes. Hello. Are you asking a question? Sorry, I thought I was hearing somebody asking a question. Okay. Right. So what I was saying is, so you will disregard that capital loss from a transaction with that connected person and ring fence it and only use it when you enter into another transaction with that same connected person. Okay. Right. So I think I'll stop there when it comes to CGT. So in the interest of time, I will stop there and say maybe if there are any specific questions that you would have around capital gains tax. Okay, so I will take it. There is nothing, there is silence. All right, if there is silence, okay, so now we're going to change and we're going to start looking at the tutorial. But before we look at the tutorial, at the risk of me killing you guys, what I'm going to suggest is the following. Okay, so we're going to maybe be clear. We're going to finish at 3 o'clock. Okay, so we'll finish at 3 o'clock. And then the only thing that's left for us to do now is to go through the tutorial and have a discussion on the tutorial. Okay, so let's do it this way so I can give you a proper break. You can get some food and all of that. So let's say time is now 1:23. Can we come back at 1:45? Okay, so it's 1:23. We'll come back at 1:45. Okay, and then after that, we'll then do the tutorial. And the tutorial is on, let me just, the name, that I've got the correct name of the tutorial. So it is, so the tutorial that we're going to be looking at is aviary. I just want to show it to you on the screen in terms of what we are looking at. And my computer now becomes slow and I don't know why. So that's the tutorial that we're going to look at. So it's welcome to Aviary Pty Ltd. Okay, right. Let's see each other. Batabile, go ahead. Sorry, I see your hand is up.
Where can we get the tutorial?
Should have the tutorial. Oswald, please help. Oswald.
The tutorial can be found on the OneDrive. It's written tutorials. It has all subjects together.
Yes, because if you've looked at the accounting tutorial or the math tutorial, it should be on the same document.
Yes.
Yeah.
Okay, I didn't find it there, but I'll look for it again.
Alrighty, not a problem. Thanks.
Just see it. It's called tutorials, so it's not divided. It's all the questions are in there.
Oh, okay, thank you.
Welcome.
Yeah, Mukhera, your hand is up.
Yes, I don't know if I'm allowed to ask when people are not here, but paragraph 39A of the 8th schedule, like it confuses me a bit. Like I don't see how it's different to any other capital losses, but then it seems like it's different. I don't know if that makes sense.
Yeah, so paragraph 39, the reason why it would be different to other capital losses, it's because that's a transaction with a connected person. So it specifically looks at transactions with connected persons.
I mean paragraph 39 cap A.
Oh. Paragraph 39 cap A, let me just quickly have a look. or it's unaccrued amounts of proceeds. Okay. Doesn't that fall outside of examiner pronouncements? But either way, if it doesn't, so effectively what that means is you've disposed of an asset. However, the proceeds do not accrue at that point in time. And therefore, what 39A is then saying is that, so it says that where a person during any year of assessment disposes of an asset and all the proceeds from the disposal of that asset will not accrue to that person during that year, that person must, when determining the aggregate capital gain or the capital loss for that year of assessment or any subsequent year of assessment, disregard any capital gain, capital loss determined in respect of that disposal. Okay, so because remember, because we have not yet determined what are the, or sorry, we've determined what the proceeds are, but they don't accrue yet. That means you're going to end up with a capital loss in 1 year, and in another year, when the proceeds accrue, you're going to end up with a capital gain. So what it's then saying is that, okay, if your proceeds have not yet accrued, even though you've disposed of the asset, you must disregard that capital gain, or that, sorry, not capital gain, that capital loss, until you get to a year of assessment where the proceeds have now accrued, and then you calculate what is your capital gain or capital loss.
I'm confused as to what do they mean that I'm confused as to what do they mean that the capitals haven't accrued because of on tax. I don't know, like if there's a disposal, does it mean that already there's an accrual? Like, because tax would
Okay,
only
what does accrual mean for tax purposes? So when we're saying an amount has accrued, what are the key things that we need to consider?
like in what terms there? What do you mean?
I'm saying for tax. So in tax, when I'm saying to you an amount has accrued, what does it mean?
There must have been maybe an agreement between both parties.
No, go back to your case law. What does it say? What does the case law say when you are looking at an amount that has accrued? And we discussed it earlier on this morning.
There shouldn't be any conditions, maybe.
It's when you are unconditionally entitled to an amount.
Yes. So if you're
Okay.
disposing an asset, isn't it that you're already entitled to an amount?
That will not always be the case. Maybe there are certain conditions that still need to be met, and therefore you are still not yet unconditionally entitled to that amount. And therefore the amount has not yet accrued to you.
So this is not because of a passage of time, because we never look at time in terms of tax, like the across system, you don't follow that.
Yes, it would be regardless of the passage of time. Yes, it would be regardless of the passage of time. We have to look and say, are you unconditionally entitled to that amount? If the answer to that is no, then there's no accrual. And therefore paragraph 39 cap A will then kick in.
Oh, okay. Now the reason because of this might be because of like the condition or something is contingent within the thing. Okay, makes sense.
Okay.
Yes.
All right.
Okay.
Thanks.